Hey, Richard.
Hi, Niña.
How you doing?
I'm great. How are you?
I'm good.
Good.
We've just finished a meeting here at the Chamber of Commerce. And as always, I like to talk to Richard about money because that's what Richard does. He's a lender. Richard, who do you work for again?
NEXA Mortgage.
NEXA Mortgage.
Mm-hmm.
And that's a new thing for you. You've just changed from a different bank.
Congratulations.
Congratulations.
Thank you. From a bank to a broker.
Okay. Well, I'm confused. What does that mean?
As a bank, you have banks' rates and you have banks' loan programs. With a broker,
Okay.
I can go to any one of 180 different lenders that we're signed up with to get a product or a rate that I need.
That sounds tedious. Does it take longer?
We have software that does that, something called Loan Sifter, which is exactly what it sounds like. It sifts through, you give it the parameters of the loan that you're looking for, and it sifts through all the lenders in our system, and it puts the ones that are most likely to have the best program and the best rate at the top.
Okay, so if I'm a DIY person and I like to do things myself, I could spend hours going to every lender out there. But you have a piece of software that lets you get something from kind of everyone.
Mm-hmm.
How cool is that?
It's pretty cool.
All right, so that's a very different thing as opposed to you just working for one bank.
Yes, it's
with
so
one set of options.
even though rates have gone up, most people have experienced that period of time in the last 2 years that was an unusual situation, a once in a lifetime, once in 100-year pandemic that shut the economy down.
Yeah.
So that drove rates down. There are many people who came into the market with the rates at that level who are now going, But the truth is, historically speaking, over the last 50 or so years, the average interest rate, if you factor in from about 1971 through prior to the pandemic, the average interest rate is between 5 and 5.5.
Okay. So you just really shifted from talking about you to talking about the market. And that's cool because that's really what people want to talk about. I appreciate that. So, and
there was a segue there.
And that's why I asked Richard to talk with us today, was to talk about the talk. There's so much talk in the market about, or in the world, about real estate and interest rates and how crazy it's been, and can you believe how high rates are? Oh, how can anybody buy anything? But you just answered that question.
And that's the reason I came to NEXA. So with a bank, if the liquidity is not right, I don't want to get too technical. You always tell me not to get too technical.
I know. He speaks banker speak all the time.
Anyway, if the bank doesn't have enough reserves and enough money to weather a high spike in interest rates, then the interest rates stay high. So most banks right now are higher than what the market is and should be.
Mm-hmm.
The reason you go to a broker in a time like that is that real or perceived, people slow down. They were looking for 2.5 and now they're looking at 5.5. So you have to have more ways to say yes. So if I have 180 companies, and let's say there's 10 that are in the bread and butter conventional loan zone where most people are, I can pick from those 10 and find the best rate.
Okay.
And typically when you have that many competitors, the rates are better, which they are at NEXA because of the broker capabilities. And I have more products. So some people I had to say no to at a bank, I can now say yes to at NEXA.
Okay.
For example, somebody who's self-employed and can't document their income properly to qualify, we have stated income programs.
Oh, I have some of those people. And I'm self-employed because I'm a realtor. I'm self-employed.
And most self-employed people, if they have a good accountant,
Okay.
they're not paying very little taxes, which means they don't show enough taxable income, adjusted gross income, to qualify.
Oh, you just made me start thinking about paperwork. And there's a lot of paperwork that goes to qualifying for your loan. So when somebody comes to me and they say, I want to buy a house, I say, are you qualified? They go to Richard and they get pre-qualified for a loan, and he asks for paperwork. What's the paperwork you're asking for initially?
Just on again, talking about a mainstream loan, not anything with self-employed, we're looking for W-2, paycheck stubs, bank statements to prove that you have money for down payment. If you don't have money for down payment, we have programs for that. And then we go through and do a pre-qualification before we get those documents. Then we do a full pre-approval, which means I've seen all the numbers.
Okay.
Unless I make a mistake, you're going to be approved.
Okay. And so then we go shopping. And after we've gone shopping and we found a house and we've gone under contract, there's still more paperwork. Tell me about the paperwork. What's next?
Well, once you're under contract, then we need to get an appraisal.
Okay.
And that typically is going to give us either the validation of the contract price, or it's going to tell us what the real price should be.
I got one back today while we were in our meeting here at the chamber. Yay. It came back exactly at the contract price, which was what we had thought was going to happen. I'm going to get to let that seller know. They'll be thrilled. And my buyer already knows. So that was
great.
good news.
That makes
so
it easy.
then what happens?
After you get the appraisal in, we go back through for final underwriting. There's probably going to be some sort of documentation we need to put together, depending on how long the loan has been in play. You might have to update paycheck stubs or bank statements.
Okay.
But typically, in a mainstream loan, you're going to close in about 21 days.
From the contract.
From the time that you actually get the contract in the application and get it submitted.
So in a month, if they've done all the paperwork with you, you could be owning a new house.
A month or less.
A month or less. That seems crazy to me. So that's wonderful. That's wonderful. Don't y'all think that's wonderful? I think that's wonderful. It's wonderful. So let's go back and let's talk about interest rates again.
Okay.
Because in the last week, today's a Thursday, I know 7 people said, "What do you think about interest rates, Niña?" Let's talk about interest rates.
Let's do that.
Okay, so give me some good news about interest rates, and then give me the bad news. Tell me the bad news, if there is any.
I think the good news is I think interest rates have stabilized. I think they're where they should be, and theoretically, again, if you go by past history, 5 to 5.5 is where you should be. The good thing about that is that it means that for now, the inflationary portion that's driving that has stabilized. I know that y'all don't feel that out there because you're still paying more than you think you should for gas, and you're still paying more for groceries, and that's real. But the reality is, from my career, when I started in 1999, interest rates were around 8%, between 7.5% and 8%. And I was refinancing people down from 11 and 12%. And when my parents bought their home their first home in 1977, they paid 19%. So factor all that in, 19%, 2.25%, which is where we ended up in the pandemic. 5% is about 5 to 5.5 is where you want to be. That's a healthy market. It does tend to slow down the housing market a bit. As you know, you're probably finding a little more inventory available now than you had in the last 2 years.
Which is so great. We have choice.
More homes. Fewer folks are having to bid over and bring more cash. That's good for the consumer. During the pandemic, there were people that were losing offers on $300,000 homes because somebody else paid $350,000 and brought $50,000 in cash. I had one that was $1 million home. They offered $1,200,000, so $200,000 over. They lost to somebody who bid $500,000 over.
Because they could.
Because
they want the home.
And they had the
get
cash.
on with their life, and that's their choice. And that may not be everybody's choice. So let's go back to the numbers, because you threw a lot of numbers out there all at once. Inflation is at 9%.
Mm-hmm.
And that's a real number right now.
It is.
You're talking about 5.5. Did you say 5.5?
5 to 5.5 depends on the loan program.
I know I don't number so well. So 5.5% interest rates, 9% inflation. That number will not stay the same. Inflation's going to change. The interest rate is fixed, but homes in our area in this market appreciated 21% on average in the last 2 years. That's a good return on your money.
My own home in 8 years has doubled in price.
Okay, that's better than 21%.
It is better
That's
than 21%,
better than
but it's
21%.
over 8 years. It's still it's still much more affordable to own a home than it is to rent.
Okay.
And if you're buying a house and you're looking at something around $2,300 a month, in this area, you can't get a decent 1-bedroom apartment for $2,200 a month.
Okay, so let me just back up. You're saying $2,200 a month. Are you including in that number? Is that just the mortgage and PMI? Does that include your taxes and insurance?
That's all in on probably about a $300,000 purchase with 10% down.
That includes taxes and insurances with 10% down.
Now you're going to have some variables.
So that's
that's an average.
Okay, what's your income gotta be for that? Let me just guess.
So it really depends on what your consumer credit debt is. However, if you go just by the payment ratio, you want to have about your payment to be about 30% roughly of your gross income.
Okay. I don't math so well.
2,200 divided by 30. That one I can't do on my head. But I'll tell you real quick.
Okay.
I can tell you real quick.
I find it really interesting because I look at the mortgage calculators online and they do not include taxes and insurance. And then when a client comes to me and they want to talk about, oh, well, my payment was supposed to be this much. What's all this other stuff that's included in it? And so that's scary to them. So what did you come up with?
About $7,000 a month. A little over 72, 73, somewhere in there.
So you got to pull in $7,000 a month. And so that could be two people or one person.
Income, sure.
So it could be household, and it doesn't matter how it comes in. So if you have some entity that's giving you that income, it could be included in that as well.
Potentially.
Okay.
Everything is based on what you document and where it comes from, and it has to be an approvable source. But if it's a legitimate source of income and you've had it for a certain period of time, even if it's irregular, if you had it for 18 months, you can probably get it approved.
Okay. Well, I'm just thinking people who get a benefit for a child or something like that.
Yeah, no, that's all. That kind of stuff is documented immediately. Yeah. So if somebody's getting any kind of government paid child care or Social Security income or disability income, you don't have to wait to accumulate that because you get awards letters that says beginning on this date you'll be getting X. We'll look at it again in a year.
Yeah.
So that's immediately usable.
And this all comes up for me because I just showed someone apartments. And to rent a place that is a 1-bedroom, 1-bath in the area that's decent, and decent is, that's subjectable, was still $1,600 a month.
Yep.
And that's paying somebody else's mortgage.
That's correct.
So what you're saying, Richard, then is that it's good news.
It is good news.
There's good news right now.
There's always good news in the market. And here's the other thing about it. There are programs that can help alleviate that situation. You always have to qualify with a fully amortized rate, which means it's a 30-year loan, whatever that principal and interest is, plus taxes and insurance. You have to qualify with that figure. But there are ways to make that easier on you. For example, we have a program called a 3-2-1 buy down.
He's numbering again.
This means that for a certain upfront expense, which can be paid by the seller, a builder, the lender potentially, or even the real estate agent, if that's how it works out with credits.
Okay.
The first year, let's say your interest rate is 5.5, and you do the 3-2-1 buy down. For your first year, it's 2.5.
Oh.
For your second year, it's 3.5.
Okay.
And then it goes up to 5.
To the other.
Then you get up to, so for the last 27 years, it's a 5.5.
Okay.
Now, you might be thinking, if I can't qualify at that rate, what's the point? The point is, you can take that money that you're not having to pay and use that to perhaps buy furniture, to just kind of subsidize other expenses,
put in
the
floors,
bank, put in new floors,
whatever you need to do.
So there are ways to mitigate that expense initially. And if rates do happen to come down, you're in a position where you've saved enough money in that period of time that it makes it affordable to refinance. So let's say it's 5.5 now, but at the end of 3 years, it's back down to 4 or 4.25. Could be. At that point, you look at refinancing. You can either use the equity, the money you've been saving for 3 years on your payment, or a combination of both, and then get another fixed rate at 4.5 or 4.25, whatever it happens to be.
Oh, okay. All right, cool. Well, I feel better, but then I've been hearing this. I hope you feel better about where we are in the market. And the reason I want to share this is because I know a lot of people who ask me these questions, and they're either looking to sell and buy another house that they've been thinking about, or they're simply looking to buy their first home. And I want to make sure that you are confident. And whether you want to work with Richard at NEXA or you want me to recommend another lender, we want you to have all the information that you need so that you can make the right decision. Richard, anything else you want to add?
Yeah, one other thing, I just came across this yesterday, and it's an interesting thing. For folks who are buying down, who are seniors and buying down to a smaller home, you can use a reverse mortgage to purchase that home, which means you make an investment of your equity into a new, smaller home.
Yeah.
And use a reverse mortgage if you're 62 years of age or older, and never make a mortgage payment. All you're paying is your taxes and insurance, and if you have an HOA, you pay homeowners association dues.
Okay.
But no principal and interest payment for the rest of your life.
Okay. Ooh. So reverse mortgages are a good idea if that's a resource that you need. Okay.
It's a great position for somebody who is in retirement, trying to save money, and has substantial equity in a larger home. Yeah.
Yeah. And we know some people who need to think about that and can help you with
We
that.
do, and that's the beauty of NEXA. There's all kinds of programs for all types of people.
Okay. Thank you, Richard. It's always good to learn from you. He's the numbers guy. That's not me. I can help you find a house, get yourself in a house, and make a brilliant decision. I'm Niña Henderson. I'm walking you home, and I'm here with Richard Schafer from NEXA Mortgage. Thank you so much.